From New York to our TV and radio audiences worldwide, this is Balance of Power, where the world of politics meets the world of business. I'm David Weston, and welcome. We always start with the markets. We had a rough day in equities yesterday. Today, the question is, are they going to continue it, or can they break the pattern? And for a report, we turn now to Abigail Doolittle. Abigail?
Well, David, it's sort of unclear at this point whether or not we will break that pattern of down markets. Right now, mixed, although it does feel as though the buyers are trying to step up. Very jittery in the first hour of trading. Actually, right now, we are all green. Take a look at that. The Dow unchanged, basically flat, but the S&P 500 at session highs up 0.8%. And the NASDAQ up 2%. Really outperforming on that FANG strength, big tech, those momentum stocks, especially Amazon, carving out a new record high. Investors going toward those stocks, that momentum complex. But the question is, David, more recently, the buying power, as shown by this week, 2 down days, 1 up day, right, for sure. Today, it's not entirely clear, although it does seem as though it would be up. The buyers are less enthusiastic. We've had horrible economic data coming out, so investors, traders, really assessing that reality. It's no longer just somewhere in the distance. It is here today. Many folks are saying that it's going to be the second quarter that's really going to matter. Some are saying that this rally has to do with traders looking past 2020 into 2021. But if the data continues to come out so poorly, it could be a problem.
So, Abigail, it's not clear what the economic data are telling investors right now. Are they paying attention to the earnings? Because we're really getting into the heart now of earnings season.
They certainly are paying attention to the earnings, David. And I think that this is another wake-up call. The banks this week really down in a big way, down more than 10%. And all the big banks reporting disappointing profits, just absolutely plunging, bigger loan loss reserves than expected. Trading is a bright spot, but Morgan Stanley this morning saying they're not sure how long that will last. So this is the reality. In March, when it was clear that this coronavirus crisis was going to create tremendous economic problems, everybody expecting it to hit earnings, especially as so many companies were withdrawing guidance. But here we have these big banks putting up the worst numbers in years, the loan loss reserve similar to what we had out of the financial crisis. So the new reality is setting in, setting a bearish tone, these banks, for the rest of earnings season. But it will be very important to see what some of the other sectors report, especially tech, because again, tech on the day, and more recently, tech has been a bright spot, holding up the markets. But the tone right now, a bit cautious. Investors do want to see what this is going to look like for the first quarter. But again, many folks out there saying that it is the second quarter that's going to be more important. But certainly right now we're getting an early tell on that relative to what March looked like, David.
Okay, Abigail, thank you so very much. That's Abigail Doolittle on the markets. We want to get the investors' perspective now on the economy. And for that, we turn to Afsaneh Beschloss. She is CEO of RockCreek Group. She's also a regular contributor, I'm pleased to say, to Wall Street Week. Welcome, Afsaneh. Great to have you here. We got some jobless numbers out today. It continues the pattern now. We have over 20 million people who've lost their jobs in the last 3 weeks or so. What do you make out of the economic numbers? Are they different from what investors really expected at this point?
Great to be with you, David, today. The numbers were more pessimistic than the market expected today. It's interesting that the market itself has not reacted as negatively to those numbers so far as we would have expected. But the interesting thing about the numbers that we saw is that they do not really they do not show the negativity of many CEOs and CFOs that we've been talking to and polling. And if you talk to a lot of CFOs right now, what they're seeing is that even if we come back at the end of Q2 or have a relatively more positive outcome, we still will have less employment coming out of this than people expect. So I have seen numbers that are up to 10 to 30% less employees when we stabilize. So that will have a very big impact on the longer-term markets, but also the economy.
Are we looking at the possibility of a somewhat jobless recovery then, Afsaneh?
Well, it may not be jobless, but it will be at a lower level of employment than I think most people expect. What we're seeing is both the CFOs of the largest companies not seeing employment come back to quite where it was after this crisis, but also, as we've seen with the PPP and the programs for the smaller businesses, those businesses are finding that it has been very difficult to actually get access to the PPPs, which have now been all fully allocated. And unless we get another batch of it, it's not going to be very helpful. Plus, it seems like the market is talking about a lot of bigger firms having had better access to the PPPs than the true moms and pops or the smaller enterprises. So again, from an employment point, it's not clear either for the larger companies or the smaller companies that were hoping to get access to the PPPs, that their employment numbers will come up as we expected. The other thing that I think is worth looking at is that, for example, in China, what the government has done is actually just push out cash through Alipay to every Chinese person or most Chinese people. So you get a cash account on your Alipay and you can buy goods with it. You actually have to exit your home. You can't order online. You have to go out, and they're trying to get people to normalize behavior, to go out on the streets to buy a cup of coffee, to get a meal, and maybe even go to the movies or whatever. But we don't really have that. We're not really accessing the end consumer through the programs we've got in the U.S.
Afsaneh, you know a lot about oil and energy. That's where you started out as an expert in that area. What about this report that the government may actually pay oil producers to keep their oil in the ground, sort of have the strategic petroleum reserve reside in the ground? Does that make sense?
You know, it's cheaper to do that sometimes than storage, especially we're running out of storage space in the U.S., but also outside the U.S. So I think, you know, if you assume that energy is oil and gas are not renewable, in fact, it means that if you keep your stock and its value goes up over a very long time, it may not be exactly the most stupid program to have. It's not exactly a common plan that the DOE has had in the past. Most of the time, I think we have expected that our storage spaces would be available and be able to do the same thing as we're talking about. Also, because all the tankers that are out on the ocean are also getting full, and most likely by sometime in April or May they will be full. We might have to stop producing, in which case there will have to be some sort of program if we want to support the industry domestically. Whether this is the way to do it, or another way might be to help the companies with their credit programs and things like that, might be more sensible.
You mentioned the possibility of the employment situation not coming fully back. And you look at the oil industry, are we looking at the possibility of some long-term, even maybe permanent changes in the structure of the industry? For example, in the shale oil producers down in the oil patch, they are really hurting. I'm not sure they'll fully come back.
You're absolutely right, David. On the other hand, I think what we're seeing, which is very surprising, some of the numbers we've been seeing this week, in fact, is that renewable energy now has reached about just over 20% of our total power grid in the U.S. And in fact, the Lone Star States, Texas, is a hub of not just oil and gas, the way we think about it, but they have been building a quarter of all new solar capacity that has been installed in the U.S., which may come as a surprise to most people who think of Texas just as an oil and gas economy. So on the one hand, you see that employment in one part of the energy sector is going down, but the employment potential for renewable energy might be going up at the same time. And the question is, will the renewables survive and actually thrive as energy prices stay lower?
In a world in which we have much more renewable energy and less of the fossil fuels, does that require as much employment? Because we can see, for example, in the auto industry, electric vehicles don't require the same number of workers as internal combustion engines.
It might be that, you know, the cars themselves don't, but or they're, you know, manufactured differently. But at the same time, installing capacity, you know, let's say solar on top of your house or in industries, it still is relatively, it does need labor, a different kind of labor, maybe trained in a different way. All the parts and all the services that you need for renewables also, or clean water or anything climate related also, will generate a lot of employment. In fact, as we speak, I would dare to say that the services part related to renewables is experiencing a problem with getting all the access to good labor and experienced labor, because we don't have that level of labor experience in services part of renewables and water and things like that. So there is a mismatch there, and if we can get our training programs up, we might be able to help some of this unemployment problems that we're seeing in the other parts of the energy sector. And I think I should also mention that in emerging markets, you're seeing the opposite trend, because a lot of them are energy importers. So just like in the U.S., we've become a very, very strong energy producer, in a lot of countries that are energy importers, they will have the opposite experience, in the sense that as their economies start coming up, they will benefit actually from these level of low energy prices, and that will, in effect, help their unemployment problems in the longer run.
Afsaneh, thank you so much. A delight to have you with us. That's Afsaneh Beschloss. She is CEO of the RockCreek Group. And as I say, she's also a Wall Street Week contributor. A program note now, we will have Wall Street Week on again tomorrow night, that Friday evening, 6 o'clock Eastern Time, as we look back at the week that was. In the meantime, we want to go for First Word News, and for that we turn now to Mark Crumpton.
David, the United Kingdom is extending its lockdown for another 3 weeks. The announcement was made just moments ago. The UK has become the 6th country to have more than 100,000 confirmed coronavirus cases. The UK says another 861 people died in the past 24 hours. The increase follows 4 days of lower numbers, but officials say that may have been because of delays in reporting over the long Easter weekend. Democrats in Congress and Treasury Secretary Steven Mnuchin will try again today to reach agreement on the next stage of an economic rescue package. Bloomberg has learned the two sides remain far apart after the first day of talks. The talks are taking place as the $349 billion federal relief program for small businesses devastated by the coronavirus pandemic has already been drained. The Japanese Prime Minister Shinzo Abe has announced a nationwide state of emergency. It's aimed at stopping cross-border movement of people and increase social distancing. Abe says it will stay in effect until May 6th. Japan has more than 9,000 virus cases and about 150 deaths. New York City's expecting the economy to crater because of the coronavirus. The city's budget office estimates 475,000 jobs will be lost in the next year, and tax revenue will plunge $9.7 billion through 2021. New York City's GDP for this year is now likely to decline 4.5%. The city had been expecting the economy to grow 1.8%. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much, Mark. As Mark talked about, the UK talking about extending its lockdown. We've had the same thing happen now in New York, as Governor Cuomo has announced that he's going to extend till May 15, the time when we need to stay at home and stay safe. Once again, until May 15 in New York. In the meantime, President Trump is playing a high-stakes game with the governors and, for that matter, with the Democratic Party. We're going to turn to our Bloomberg political contributor. He's Rick Davis to talk about exactly what's at stake. That's coming up next on Balance of Power on Bloomberg Television and on radio. This is Bloomberg Balance of Power. I'm David Weston. President Trump is slated to announce an approach to reopening the U.S. economy this afternoon, although it looks like he's backed down a little bit from that confrontation he'd gotten himself into with some governors about who's going to be responsible for implementing that plan. We welcome now our Bloomberg political contributor. He's Rick Davis of Stone Court Capital. He also has done so many things in politics, including running John McCain's campaign for president. So, Rick, great to have you back with us. Thanks so much. Let's start with this plan to reopen. Is this really a pretty high-stakes game for the president? Because if this works well, he becomes a hero. If it doesn't work well, if you break it, you own it.
Yeah, well, thank you, David, for having me, and I hope everybody's doing well in your Bloomberg world. Yeah, I mean, Trump kind of owns this anyway, right? I mean, this has been a very high-profile crisis. He's taken ownership by doing these daily press conferences and has taken credit for as much as his administration can possibly do in the interim. And so anything goes wrong, of course, that falls on his shoulders too. So the biggest question the administration has right now is how to start this economy going again. His indicators are horrible. I mean, we saw massive layoffs and unemployment over the last month, and I think he sees getting back to work as a prerequisite to his reelection, and so I think he's got an itchy trigger finger for that.
Yeah, clearly, if the economy gets going again, it really helps him a lot. On the other hand, if they start too soon and we relapsed over the bad old days when we were really climbing dramatically in the number of infections and, for that matter, deaths, he's got a real problem.
He does, and this is something that he has very limited control over. As you mentioned, governors have a significant impact on what the rules are that apply to their individual states, and they all have different challenges. Big urban states like California and New York have different challenges than Midwestern states with lower population levels and less concentration. So to have some broad-reaching national policy that helps people get back to work and spurs the economy is going to be very difficult. He's going to have to work with these governors, all of whom have their own agendas, both as governor and trying to maintain the health and well-being of their states, but also as politicians who have a point of view on what the elections are going to be like come November.
Rick, as you suggest, it certainly looks right now, at least, like the big issue come November in the presidential election will be how this coronavirus crisis was handled. What does that pose as a difficulty for Vice President Biden, former Vice President Biden, and his campaign? Because to some extent, they're almost passive in this. They can't take too much initiative. The president has the initiative. What can they do besides sit back and wait and see how it plays out?
Yeah, I think that's exactly what they have as an option, is to sit back and wait and see how it plays out. I mean, to some degree, this election was always going to be about Donald Trump, right? I mean, anything Donald Trump does is all about Donald Trump. So this likely was going to stack up to be a up or down vote on his first term of office, which would not be unusual for sitting presidents. But even more so because of the pandemic, this will really be a referendum on his leadership and whether or not people feel like he's done everything he can to maintain both the health safety of America but the economic safety of America. Biden will have a very limited ability, probably late in the game, to create a contrast with Trump. There'll be plenty to do there, but he's going to have to pick very carefully what issues that he strikes out on, because the American public, it's hard to predict what they're going to care about come September and October of this year. But we do know one thing for sure, is their health and economic security are going to be at the top of that agenda.
Well, and speaking of health, one last question. Do Republicans who resist the idea of mail-in ballots run a risk? Did we see that perhaps in Wisconsin when the Republicans really forced people to come in person to polls?
Yeah, I think this debate about vote by mail is really overheated within the Republican Party. I mean, traditionally, Republicans feel like they have a disadvantage for people who vote by mail. There was a major effort when Motor Voter was first started, which is you get registered to vote by being a licensed driver, and all these things actually just bring people to the polls. One of the states that has almost all mail-in ballots is Utah, and they do quite well as Republicans in Utah, and so I think there's a lot of heat, but no fire when it comes to vote by mail. The reality is this is going to be an intensely involved election. People are going to want to do something, and making it easy for them to do it is going to give Republicans just as much advantage to turnout as it's going to be for Democrats.
Yeah, whatever happens, it's a very different election. Rick, it's really great to have you with us. That's Rick Davis, among other things, our Bloomberg political contributor, I'm proud to say. Later on in the program, we're going to have an exclusive interview with Dallas Fed President Rob Kaplan. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It is time now for Stock of the Hour, and it is United Airlines, the worst performer of the day, down around 10%, more or less. And to give us a report, we turn now to Kaylee Lyons. Kaylee?
David, well, we are expecting earnings from United after the bell today. The company hasn't confirmed that, but that's what we've estimated. And clearly sentiment isn't great going into that print. The stock has already lost about 70% of its value this year, of course, due to the total collapse in air travel demand we've seen as a result of the coronavirus outbreak. Now, analysts expect United is going to lose roughly $2.60 a share this quarter. That's relative to profit of $1.13 in the same quarter last year. Obviously, these estimates have been dramatically re-rated over the course of this year. Earnings estimates for both North American carriers like United and Asia Pacific carriers have been cut by about 200% so far this year. And the issue is that it's really just not going to be a first quarter only problem. What's really driving the losses today for United is a letter that was sent by CEO Oscar Munoz and President Scott Kirby to employees last night, basically signaling that there is no light at the end of the tunnel. They said travel demand is essentially zero and shows no signs of improving in the near term. They actually expect demand to remain suppressed for the remainder of 2020 and into next year. To give you some perspective as to how suppressed that demand is, they say that United will fly fewer people during the entire month of May this year than it did on a single day in May last year, David.
Yeah, and to give you some sense, Kelly, you probably heard this number. In New York area, they reported that the air traffic was down something like 96% at the airlines around here. At the same time, there's help in the form of government bailout, right? They've come to terms?
They have gotten some help. United specifically is getting about $5 billion in grants and loans, and that does help from a short-term liquidity standpoint, and it's really focused on payroll costs, but that's only about 30% of United's total costs, so that means they're still going to have to make deep cuts elsewhere. Really, analysts weren't that happy with the government program, given the fact that airlines are on the hook to repay about 30% of the money they get, and frankly, it isn't enough to offset the demand problem, even with government aid, David.
Okay, Kaylee, thank you so much for that report on Stock of the Hour, which is United Airlines. That's Kaylee Lyons. Coming up here, we're going to talk with Representative Katherine Clark of Massachusetts about what's going on up on Capitol Hill as they're stalled over appropriating more money for small business. This is Balance of Power on Bloomberg TV and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Congress has already passed three major pieces of legislation to try to help the U.S. economy, including that $2 trillion spending package. But we're told that as of today, we are already running out of the $350 billion that was appropriated to help small businesses, and attempts to try to replenish that have stalled up on Capitol Hill. We welcome now Congresswoman Katherine Clark. She's Democrat of Massachusetts. She sits on the Appropriations Committee. She also is the vice chair of the Democratic Caucus, which makes her one of the members who is in leadership. So, Representative Clark, thank you so much for being with us. Let's start with that attempt to try to replenish some of the money for small business. Where does it sit?
Yeah, as of today, we know that the Paycheck Protection Program is likely to run out of money. And we have been working to get the Senate to support our interim emergency package that would replenish that program with $250 billion in additional assistance, and would focus half of that amount to make sure that our women-owned businesses, our veteran-owned businesses, farmers, rural communities, and underserved communities have better access to those funds. In addition, we want to make sure that we are continuing to support our hospitals, community health centers, and health systems, and an additional $150 billion for state and local municipalities. We know this is a healthcare crisis first, and if we want to help our small businesses and keep the focus on our workers who have been displaced, we have to address the healthcare crisis simultaneously. And that's what the Democrats are pushing for, and we certainly hope that the Republicans will join us and that Secretary Mnuchin will understand that these two things can't be separated and need to be taken up as soon as possible in Congress.
Is this an either or is there room for compromise here? Because there certainly is an urgency for all of the things you talk about, both for the replenishing of the money for the small businesses as well as money for hospitals and states.
Yeah, I mean, we believe that these go hand in glove. We cannot restart our economy. We cannot get the aid out that, workers around the country need if we do not have the hospital and community health centers and the assistance to states who are expending just records amount of funding, providing these life-saving services to Americans. And so these all go together. And we cannot just give aid to our small businesses if we're not also taking care of the hospitals and healthcare systems that are supporting those people. This is first and foremost a public health crisis, and we have to continue to address that as we support the backbone of our economy, which is our small businesses.
Yeah, even as we're speaking, Congresswoman, we're told that Nancy Pelosi, the Speaker of the House, says that she's still negotiating over additional relief funding. You're, as I say, a member of leadership on the Democratic side, vice chair of the Democratic caucus, as well as on the Appropriations Committee. Given what you know up there, do you think this is going to get resolved? And if so, within what frame of time?
We certainly hope that it will be resolved today and voted on as quickly as possible. That is what Democrats have been pushing throughout this process, as we have been taking the lead on ensuring that we make these emergency relief bills tailored and aimed at the needs of Americans. And first and most pressing are their health needs. Getting the protective equipment, making sure that we have the ventilators, ensuring that we are expanding testing to meet the needs. We don't always have a cooperative partner in the White House, and we are alarmed at some of the misinformation and the eagerness to open this economy before it could be safe to do so. So we are going to continue to press that we do both things at the same time. Recognize that this is a health crisis and that people in my district continue to be, and across the country, primarily concerned with preventing their families from getting this virus and helping those in their communities who are already struggling with it. And we want to support those first responders and healthcare workers and grocery store workers who are at the front line. But we have to do both. We have to make sure that our small businesses are not destroyed during this pandemic and that they have what they need to be able to reopen when we can securely do so.
Right.
So we are ready to act with the urgency that is required, and we hope the Senate will join us today.
And finally, Congresswoman, you mentioned your district. Give us a sense of what's going on there. We listen to Charlie Baker, your governor, pretty much every day at a news conference. It feels like things are getting worse. Give us your sense of what's going on in your district.
Here in Massachusetts, we have been dreading this time period. It appears that we are now in the surge of cases, hospitalizations, and unfortunately and tragically from deaths. We crossed a gruesome milestone of the loss of 1,000 people, and we have surpassed that already today here in the Commonwealth. And one of my communities, Revere, Massachusetts, is one of the top 10 in the state in deaths per capita. And so we are struggling, but we are also seeing inspirational heroism with our first responders, with our public and private entities coming together to help support our communities in this very, very challenging time. so, as always, I'm very proud to represent this district that is on the forefront of trying to stay home, to wear our masks in public, to do whatever we can to slow this infection rate, and investing in research and finding a cure and a vaccine, which I think very much will be the innovation that we're going to see to help us address this virus. It's going to come out of my district in many ways. And so it's really the best of times and the worst of times here in Massachusetts.
Indeed. Well, I know all of our thoughts are with you, Congresswoman, and your constituents. Thank you so much. That's Congresswoman Katherine Clark. She is a Democrat of the Commonwealth of Massachusetts. And now it's time for First Word News, and for that we go to Mark Crumpton. Mark?
David, thank you. Italy is reporting its highest new coronavirus cases in 4 days. The government says there were more than 3,700 new cases, over 1,000 more than the day before. Italy now has nearly 169,000 confirmed virus cases. The Prime Minister, Giuseppe Conte, is working with emergency task forces to map a restart for businesses who are being crushed by the nationwide lockdown. China is denying allegations that the coronavirus pandemic may have started in a lab near the city of Wuhan, where contagious samples were being stored. China also denies it delayed announcing the outbreak and underreported cases. The virus is widely believed to have originated with bats and to have been passed from another species to humans at a so-called wet market in Wuhan. A firm determination has not been made. The Kremlin says that Russia will gratefully accept President Trump's offer to provide ventilators for coronavirus patients. The president said Wednesday the U.S. was ready to send ventilators to Russia, saying, quote, "They're having a hard time in Moscow. We're going to help them." He added the U.S. also stands ready to provide ventilators to other countries, including Italy, Spain, and France. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much, Mark. Coming up here next, we're going to have an exclusive interview with Dallas Fed President Robert Kaplan. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. We now welcome for an exclusive interview Robert Kaplan. He's the Dallas Fed President. So welcome, Mr. President. Thank you so much for being with us. I want to ask you about your outlook on the economy, because as recently as a couple of weeks ago, you said that it's going to be rough. We're going to come back in the second half. We may have unemployment as high as 15%, mid-teens, something like that. Have the recent developments changed your views on that any? Do you think it's any worse than it was before?
I think it's basically, my view is basically the same as it was 2 weeks ago. I think we're going to have a substantial contraction in the second quarter, and we've said publicly annualized as much as 25 to 30%, but that's annualized, so multiply by 4. We think we'll start growing again in the third quarter, and we will continue to grow into the fourth quarter. I probably would say today that peak unemployment may be closer to the mid to high teens, so maybe a little higher than I'd said before. And we still believe that we'll end the year with an unemployment rate something like 8 or 9 or 10%, but in that range. And the challenge going into 2021 will be to work that unemployment rate down.
So there seems to be a range of views among Fed presidents as well as the board, which is why you have multiple people, so you have different views and they're expressed. But if you take Mr. Bullard on the one hand saying it's going to be a sharp V, and you have Mary Daly now saying, boy, this could really drag into next year in a recession, where do you put yourself on that spectrum?
Here's the worry. Here's the challenge. Going into this situation, we had sluggish manufacturing, sluggish business fixed investment. Obviously, a lot of it had to do with weak global trade. But the one thing we had going for us as an economy is we had a very strong U.S. consumer. We had a low unemployment rate. Household balance sheets were in reasonably good shape. And that was 70% of the economy. The challenge is, as we come out of this later this year, And with if the unemployment rate really is 8 to 10%, you're going to have a weakened consumer who's going to, you would think, save more, be more careful, be a little bit more reluctant to spend, and that's going to be a headwind for the economy. And it may take a while, and I mean into 2021, for the consumer to get his or her footing back. And I think that'll be dependent on how quickly we can run down this unemployment rate to lower levels. So do I think it's going to be a V? I think the consumer situation makes me think that we'll have a recovery, and it'll be a solid recovery in the second half of the year from the levels we're at. We're still going to have a 4 to 5% contraction for the year, but then the question will be, what's the pace of growth, and what's the state of the U.S. consumer? Those are the questions, and that's the issue I'm most worried about.
And the psychology of the U.S. consumer, it strikes me, is not simply being somewhat more conservative because they got burned in a downturn, but also being concerned about their personal safety. How willing are people going to be to go back out, even when they're allowed to do it, to go to restaurants, to go out and spend, to really participate in the economy? Will there be some reluctance just because of personal safety concerns?
Yeah, so there's three levels of issue with the consumer. One is personal safety, as you mentioned. This is why testing, ubiquity of testing, is so critical. If you had widespread testing at scale, I think that would do a lot to give consumers confidence to go into the workplace, to go out to restaurants, to go into other public gatherings. But that's very much dependent on how available is rapid testing. The other two issues are job insecurity. I just saw a survey from the New York Fed that said something like 70% of all workers are worried about their jobs, about losing their jobs. So there's that insecurity. And then the last issue is just what's happened to the consumer financially, and particularly that segment of the population, which is sizable, that doesn't have much savings and lives from paycheck to paycheck. And this is going to make it so they're even more cautious. So those are the three big issues that affect the consumer.
As we look at the models that you all run at the Fed, is it likely this pandemic will actually affect the potential growth for the United States? I mean, I think before it was probably around 2% more or less. Does this take that number down somewhat going out into the out years?
Yeah, it may, and so we'll have some snapback growth in 2021. We'll grow faster than potential next year. We'll grow at a higher rate. If potential is 2%, we think we're going to grow a lot faster than 2% because we're making up for what happened this year. But after you get into the future, there's two things that drive potential growth. One is growth in the workforce, and the second is growth in productivity. And the concern I'd have is you have a number of people that are going to lose their jobs and are going to have to find new jobs. Some of them who are older, it's possible will decide to retire, i.e. just withdraw from the workforce. Others will need to get retrained. Some will find it hard to find other jobs. So workforce growth, as we're running down the unemployment rate, you would expect a good rate of workforce growth. As we run that down, though, we had a workforce growth issue coming into this because we're aging. Demographics were such we already had a workforce growth challenge, and we're going to have to relook at that. And that means job training. It also means revisiting a sensitive subject, immigration, appropriate immigration, ways to grow the workforce. And then the second issue is productivity, and I've talked a lot about that here at the Fed. The U.S. going into this lagged the world in math, science, and reading. We ranked 25th out of 35 industrialized nations. And while we've beefed up skills training, we also are not doing it fast enough to keep up with the changes with technology and technology-enabled disruption. So, and you also worry about, will the level of government debt squeeze out some private investment in CapEx? So we're going to have to address all those issues, and I know we can, so that we can grow faster. But otherwise, yes, potential growth could slip. And we already thought going into this crisis, we were concerned that potential growth was going to erode over the years because of those drivers I just talked about.
How much could it slip, do you think?
Well, my concern, if you talked to me in January, I would have said the potential growth in the United States maybe is 1.75% to 2%. And what is that made up of? Let's say 0.5% in workforce growth, and let's call it 1.25% to 1.5% growth in productivity. If we still got to address the workforce growth issue because of aging, and so that hasn't changed. And then the issue is productivity going to get better or worse? And so we already thought in January, if you'd asked me, that over the next 5 years we could see potential growth slide from 1.75% to 2% to closer to 1.5% to 1.75%, heavily due to demographics, by the way. And then the question in our minds was, could productivity improvements make up for it? I've still got the same concern.
Let's talk about specifically your district, because it's right in the middle of the oil patch. The oil industry is really taking it really on the chin right now. Give us a sense how you evaluate the effect on your district and the economy in your district, not just from the producers themselves, but also all the service providers and things like that. There's a lot of jobs involved in oil exploration and development.
So the oil business and related businesses is roughly about now 9% of Texas GDP. That might surprise people. But over the last 25, 30 years, the state has grown dramatically, and we've diversified into a number of other industries. But even with that percentage, 9%, this is as everybody knows, extremely difficult time for the oil business. Why? The price of oil is down dramatically because of oversupply, and it's not economic for a lot of producers to produce. So what they're doing is they're shutting in production. They're stopping production. You'll see a number of failures in the industry, and people just can't make it through this. And then for the service providers, they're obviously suffering because there's less production. And so we even before this crisis had expected CapEx in the energy sector to be down 10 to 15% this year. It's going to be down dramatically more, and obviously there's going to be job losses. The big issue in the short run, though, is even though when you look at your screen, you see the quoted price of Brent and WTI West Texas crude, the local price is even lower. And why? Because we've got so much oversupply. We're on the verge of running out of storage. And so if we actually fill up the storage where there's no place to sell the product, you'll actually see the local market prices being well below the quoted market prices. So that makes it even worse for producers, where they just can't make a profit at these levels. And that's where we are right now. Now, after we get people back to work and we start to resume appropriate consumption, some of this excess is going to take several months to work off and into next year, and then you'll get to a more balanced market. But right now we have an extraordinarily imbalanced market, and that even takes into account the recent deal between Saudi Arabia and OPEC+. It just wasn't enough to overcome the huge amount of daily oversupply we have right now.
There's a limit to what the Fed can do to address that. Is this a time for fiscal intervention? And it could be either out-and-out bailouts, or now we have reports that maybe the government's thinking about essentially paying producers to keep the oil in the ground, sort of a strategic petroleum reserve in the ground. Do things like that make sense?
Well, I'll leave it to the fiscal authorities to make those decisions. The point of it is we're getting to the point where there's nowhere for the production to go. There's dramatically reduced demand, and there's nowhere for the production to go, and so I could see why the government is considering incentives to encourage producers to produce less, because all it's going to do is fill up the tanks faster and cause the price to plummet even further. So this is an extraordinary situation. It'll eventually work itself through, particularly once we get the economy back turned on. But in the near term, I talk regularly to people in the industry. They've never seen anything like this, and because they've never seen the demand destruction that we're seeing. So I could see where extraordinary steps to keep those tanks from being filled up could well be appropriate. The
Fed has done an awful lot already. It did last week. It took a lot of people's breath away. What's next? I mean, we've had now Nancy Pelosi, the Speaker of the House, suggest maybe there should be loans made to mortgage tenders, to things like nonprofits and things. Would you be in favor of expanding out the lending facilities to other sectors?
So what's going on right now at the Fed is we're standing up a number of these facilities. So we've announced a number, and a number are already up and running, and some of them have been announced but are not up and running. So we're furiously working around the clock here at the Fed to get a number of these facilities set up to where money is being dispersed. Then beyond that, to your question, we're continuing to look for pockets of the economy that have been overlooked in what we're doing, and through no fault of their own, are under stress. And so I would say my own mindset would be we should be open-minded about continuing to look for areas, whether it's nonprofits would be a good example. The issue of mortgages, mortgage servicers is something obviously that's under a lot of stress. What our goal is to have appropriate market functioning, and the other thing our goal is to keep intact to the maximum extent possible businesses and nonprofits that went into this healthy and only are under stress because of this situation, and we would like to do what we can to help them come out the other side and continue to function. So I think in that vein, I'd be open-minded about what else we might need to do.
Which takes us exactly to a really challenging point, that so-called moral hazard. The ones who came into it healthy through no fault of their own, they're under stress, as opposed to some who came in not so healthy. Sometimes you have to bail out both. You have to help both just to get this through it. Are you concerned about the moral hazard, and how do we come back off of that and return to a world where you are rewarded for prudence and you're not rewarded for the opposite?
So I am concerned about that, and that's why on the corporate corporate bond program, we've sort of set a cutoff of I think March 22nd, March 23rd. If you were investment grade on that date, you're in the program. So that will include some fallen angels, i.e. companies that were investment grade but have been downgraded. We have said that we will buy high yield ETFs, but that's going to be in relatively small size, and it's intended to help market functioning. But yes, I am concerned about, from the Fed's point of view at least, intervening in help in businesses where they were leveraged going into this, and we are taking action in those cases. I think that's really an issue for the fiscal authorities to decide, and that's really their judgment. I don't see that being the Fed doing that.
Thank you. Thank you so much, Robert Kaplan, President of the Dallas Fed. This is Bloomberg.